A very good afternoon, good morning. Welcome to HYCM workshop with myself, Giles Coughlin, a Chief Currency Analyst. Very good to have you here. Looking forward to taking us through the session. And before we get going, don't forget, as we talk about different entries, exits, all of this is done from an educational perspective. And the reason being is obviously I'm not here every hour to update folks on the latest market dynamics. But the whole idea of these sessions is you look over my shoulder, someone from a professional trading background, you see how I go about making trading decisions, how I combine the technicals and the fundamentals together, and then that helps us understand how to trade and how to take these things forward yourself. That's the whole sort of philosophy behind these sessions. Those of you who are regular are more than familiar with that. Don't forget, the key concept on this workshop is this one simple idea we need to keep going back to over and over again, and it's this. When we're trading currencies, we're trading strength against weakness. That's the key philosophy that a macro FX trader has cemented into their mind. Which currency is strong, which currency is weak. And understanding that is really the key to understanding how to trade from a global macro perspective. Don't forget, as we go along, if you've got any questions, please do ask in the Q&A box. We will also run through the latest RBNZ interest rate decision. That has been a lot of movement in the New Zealand dollar. I'm just going to run through that and a potential opportunity in the Euro New Zealand dollar pair that is coming up. So we'll run through that as well. And I'll just explain what the moving parts are to that. So without further ado, we will get stuck into the session and I'll head over to the main screen. Now, remember, trading strength against weakness is the key philosophy behind trading. And this is one trade that I've recently taken and have been flagging up, which is pound Australian dollar. Now, we have reasons medium term for pound strength. The UK economy is opening up. This week we saw some very good labour data out of the United Kingdom showing a near record 1 million jobs available, showing that the job market is really abundant with opportunity for job seekers. And the successful vaccine programme with 75% of the UK population being vaccinated has been a broad support for the expectation that the UK economy is on track for a good, strong recovery heading into year end. Now, all of that has been supporting the pound. Now, one of the key trades we've been taking, and I think some of you will remember this trade that I took earlier in the year around July. It was around this sort of 6th of July time when we had a very clear outlook that the UK was going to be vaccinating its citizens far quicker than Australia. And the outlook for the pound was stronger than the Australian dollar by some margin. And went long in July, and I took profit up into that 1.86700 region, if I remember right. Now, currently, we've had this symmetrical triangle pattern. Now, if you don't know how to trade the symmetrical triangle pattern, do check out my blog. I'm just going to show you it here. And in my blog, if you just go to blog.hycmlab.com, I'll pop this here in the terminal. And if you go into the search bar and just simply search symmetrical triangle, right, you will see how to trade the symmetrical triangle pattern. I go into the pattern in some detail, so I'll just share that with you now. Do check out that pattern. It's a short video, just hit play, and I really go through the details of exactly how to trade it, where to put your stops, how it exactly works. So do check that out. Now, this is a symmetrical triangle pattern. They're often good continuation patterns, and the entry was simply on the break of that 1.890 region. So it went long on the break, and you can see price moving higher. Now the target is the height of the pattern. So the pattern is from 1.8700 roughly up to about 1.900. So it's a 300 point height approximately. And so you're looking for about 300 points from 1.8900. So that takes you to 1.9200. So the target is 1.9200 for the break of this pattern. You can see that actually that was a very similar symmetrical triangle kind of pattern here that we saw around June, July, though I traded it for a different reason. It's, you know, it's not too much of a stretch to see that little set up as a symmetrical triangle. Apologies, sometimes this chart gets a bit sticky. So looking at pound Australian dollar, any return to this 1.8800, 1.8900 region is still suitable for going long. Now, we've got the reasons for the pound strength. The reasons for the Australian dollar weakness are numerous. China has shown a slowdown in growth. China's economy drives Australia's economy. When China slows down, Australia's economy slows down because of the close connection between the two. Also, if you look at the commodity space, you would have noticed this really significant fall in iron ore. You can see that iron ore is just continuing its pressure lower. Now, the reason for the fall in iron ore is because China has tried to cut down on its greenhouse gas emissions. Now, a large proportion of those emissions, about 15%, come from its steel production. Now, steel production obviously uses significant amounts of iron ore, and they're limiting their steel production. That means the demand for iron ore is less, hence iron ore prices have been selling off pretty sharpish. Also, you can see copper prices pushing lower as well, and that has further pressure on the Australian dollar. Now, 20–25% of Australia's exports are iron ore, and 80% of those go directly to China. So falling iron ore prices is a pressure on the Australian dollar. So you can see Australian dollar weakness. Also, significant disruption in Australia now because of the Delta variant. They have not vaccinated as many citizens in their country. So that means that the Australian economy is far more vulnerable to the spreading Delta variant than the UK, because the UK, for instance, has a high vaccination program and low hospitalizations and low deaths, because largely speaking, in terms of the broad population, although there's obviously individual tragic cases, which is very sad, broadly speaking, the support is there for the UK economy, and the vaccines are supporting that return to growth. So pound Australian dollar upside remains in place. Any retest of that symmetrical triangle, you'd expect that to carry on. The risk to the trade is if the UK economy slows down, or there's some really, if Australia really managed to turn around the Delta variant, if China starts growing again, if iron ore prices sharply move higher, anything like that is a risk factor for this trade. But at the moment, that pound Australian dollar upside makes sense. Now, the market at the moment is acutely focused on what's happening with the FOMC meeting minutes. They are due out later on today, and if we just take a look at the dollar, I'll just talk us through what's been going on with the dollar index, and that will help us understand the picture over the last sort of couple of weeks. Now, it was around the middle of the week, around the 4th of August, when we had Fed's Vice Chair Clarida start to reveal to markets that he could see a case of interest rates rising as early as 2022. That boosted the dollar higher. We then had a couple of events. We had, first of all, the inflation data out of the US on the 11th of August was a disappointment. Now, that CPI data meant that any early fears that inflation was getting out of control were contained, as expected. But inflation was still seen within the economy generally. So we only saw a mild reaction to that inflation miss. This sharp fall on the 13th of August was due to the University of Michigan sentiment that had a very poor report. and it was one of the lowest readings for a long time. There was a generally negative outlook from the 500 consumers who are surveyed for that. And some analysts put a lot of emphasis on that University of Michigan sentiment report. So when it came in very weak, we were having a very slow day last Friday. Summer holidays, people are away, but then that boosted the dollar, and you can see the dollar fell sort of 0.5% on the day, which by the dollar terms is it's quite a large move. And as a consequence, expectations were thinking, well, the Fed maybe won't have to taper after all because the consumer is so fearful of the Delta variant. We then had the US retail sales on Tuesday, yesterday, and they were a miss of expectations, but they weren't as bad a miss as feared. So the dollar was able to recover. Now we have the meeting minutes. What will investors be looking at? They're looking at two things. How quickly will the tapering start, and how much? So it's how fast and how much. And this is what to look for later, okay? Now, if the Fed in the minutes start to lean towards an early taper, that's the fourth quarter of 2021, and a large taper, say like $20 billion and $10 billion MBS, then expect dollar strength, and I would like a US dollar yen upside. So dollar yen upside, you can see here, we're in that near-term support level. We have a Harami inside bar. We're breaking to the upside. Expect that to move higher and a retest of 110.40. That's what I expect over the next couple of days if we saw that. If the Fed reveal that they're only looking at tapering in the first quarter of 2022, so next year, and say it's a small taper of only $10 billion and 5 billion MBS, then expect the dollar yen to maybe move sideways to lower. Okay, so that's what to expect. Now, the reason I say the dollar yen is because the dollar yen is very sensitive to the US 10-year yields. Now, what the US 10-year yields are telling you is what the market's thinking about interest rate hikes. If 10-year yields push higher, it means they're expecting interest rate hikes to come. So sooner tapering and faster tapering is positive for the US 10-year and positive for the dollar yen. So the currency expression is to go long the US dollar yen. Now, the commodity expression will be to go short gold. But that's only if the Fed look like tapering sooner than expected. So you'll be looking at shorting gold. Just go over to the gold chart. There we go. So like shorting gold at market, looking at support 1760, next level down is 1700. So that's what to look for the FOMC meeting minutes. It's also worth just looking at the inflation data out for the CAD. We have just seen that release, and that came in quite strong, and that has shown some CAD strength. Let's just have a quick look at that together. That just came on as the webinar started. Here we go. Let's have a look here. It's one of our partners, Financial Source. I'm one of their key analysts. So we saw that the inflation came in at 3.7 versus 3.4. That's above maximum expectations. Core came in at 0.6 versus 0.4%. Common was a bit of a miss at 1.7 versus 1.8%. Month on month, 0.6. That's a beat. And the month on month, 0.5%. Okay. And core 0.6% above the previous of 0.3%, trim 3.1%. So yeah, look at that, year on year 3.3%. So bigger than expected. So that does open up a bias for CAD strength. Now remember what I'm talking about, trading the strength against weakness. So that means we're expecting CAD strength now, and we know we've got Australian dollar weakness in the market, so that means an Australian dollar CAD short would be suitable now for trading intraday. So this is like good for your learning. You know, if you're just new to this, you can now look and see that you expect. Okay, so now we can see the Australian dollar CAD. Let's just look at this from a zoomed out perspective. Look at that. That's strong support. So that's support. That was resistance. Resistance broken. Right. If that level breaks, that will be significant. We have a Harami inside bar that's breaking to the downside. If we look at this on a monthly chart, we can see the green crossing red. This is looking like it wants to move down into that 0.900 region. So I think that could be suitable for going short on. Certainly, let's have a look here. 4 hour. Let's just see what we've got. Yeah. The only thing you have to watch out with this is that CAD is also driven by oil. Okay. So from an intraday perspective, it's possible to short at market or ideally and a move back up to that 9177 region. So any retracement back up to that 9177 can be considered suitable for shorting on an intraday perspective. And if you notice that 0.9177 level is also that key support level. So any retracement back to that 9170 region can be considered for shorting. You could also short at market because that should be supportive for the CAD going forward. And you can see that there is potential for this level to break lower. So the other option is if you didn't want to risk that break, you could simply just wait for that level to break. If the level breaks lower and we move down to that support, that S1 level, so if this level just breaks, then you could look a retest back into that level. So there's two options. There's three options. Sell at market. First target is into that 0.9128 level. That's legitimate. That's fine. There's enough sentiment in the air. Sell at retracement 9177. And so if this spikes high, expect sellers at market moving down to 0.9126. And the third option is wait for a break and then a retest of that level and look for it to go lower. So Australian dollar, weakness, rising COVID-19 cases, falling iron ore, slowdown in Chinese growth, reduction in steel production from China on green emission concerns, Canadian dollar, stronger inflation. That means that the bullish outlook for the Bank of Canada can continue with some pressure on the Bank of Canada potentially hike interest rates early. So just for your learning, you know, you'd expect to find this pair pressured, right? And they're both commodity-based currencies, the Aussie and the CAD. So they both should be equally impacted by the risk tone. So that's how we do it, folks. That's the way it works. The risks to the trade are obviously the fact that if we got, and this is the main risk, you know, we need to be aware of it. If you just look at oil prices are pushed around by CAD. I've moved the CAD significantly. So if these oil prices drop lower and they crash through 65, then that would invalidate the outlook for the trade because it would neutralize the CAD. The CAD would find weakness. But if oil spikes higher, that will accelerate the trade lower. All right. So that's definitely one to look for. The other aspect to look for in trading the CAD is that it's a commodity-based currency. So when risk is off, the CAD also finds weakness. But so does the Australian dollar. So by trading the Aussie CAD cross, you mitigate some of that risk. Okay. See bot yields just picking up a little bit in the session, which is good. That's positive for risk. Notice copper dropping lower through that level. Significant level, copper's falling. That is a negative sound. A little tip. One of the names for copper is Dr. Copper. So with copper falling, that means the health of the world economy is showing signs of weakness. Okay? If this level holds, that's more positive, but copper's falling lower. We also see that bonds have been finding some bids, and they've been pressured broadly, picking up a little bit, but the bond market is showing signs of stress. We can also see that global equity markets are showing signs of stress. S&P 500 breaking lower yesterday, Dow, Nasdaq, the DAX, Euro stocks, ASX 200, FTSE 100, all pressured to the downside. And notice this, look at the VIX. When the VIX rises, stocks fall. This is the S&P 500 chart. So rising VIX, falling stocks, rising VIX, falling stocks, rising VIX, falling stocks, rising VIX, falling stocks. It's ringing alarm bells. So this is not the time to have significant open risk in the global indices. China's slowing in growth. Iron ore prices are falling. Copper prices are falling. The growth and inflation outlook has pulled back slightly. Little alarm bells. The VIX volatility trending higher. We can see here a series of higher highs and lower lows on the lower time frame. Higher high, lower low, higher high, lower low, higher high, question mark. But notice how the VIX rises, stocks fall. If VIX keeps pushing higher, then stocks are falling. We want to see a break of that trend line to give us some confidence that the trend is moving lower in the VIX. Okay, at the moment, it's definitely trending higher. So, one to watch. Be very careful of risk in the global indices. So, I hope you can see some of the risks that are out there. If there's any particular instrument you want me to look at, please mention that to me. The big event is the FOMC meeting minutes, and that's the one to be looking for. You can see that the dollar yen is moving higher, dollar moving higher. Expectations are that we see some kind of an announcement in the minutes, or the market's really hungry for a move. You can really see that and sense that. So I'm just going to check the terminal, see if anyone's got any questions. Right. No, Georgie, I went live and I ended up losing a lot, more than 2/3 of my investment. I'm sorry to hear that. What's your advice on recovering my account? Right. When you have a disaster like that, okay, there's a few things to know. The first of all things it tells me, Georgie, is you are not ready to trade yet. If it gives you any sort of knowledge to help you, like, I am aiming for a double-digit return each year. I'm trying to get a double-digit return. So last year I made about 21-22% on my account, right? And I'm not using leverage or very small amounts of leverage. So that means that my worst losing trades should never mean I end up losing a huge amount, like, you know, like the amounts that you've lost. So the first thing is you need to do is you need to know how to manage your risk. So what I'm going to do is going to see if I have a article on my blog to give you some help here. So go to my blog and look, just type in risk in the search bar and see if I've got any helpful articles that I had. I'm just seeing, I have written a lot of articles on risk, and I'm just seeing if I've got anything here to help you, because that's clearly a risk strategy. Okay, so first of all, I'm going to give you this article in the Georgia. Okay, so check that article out there, how to decide which currency pairs to trade. And in terms of risk, I'm just going to send you another article I've written. Right. I'm also sending you an article in the Georgia. Here, I'm sending it to everyone on risk management. That's what you need to realize. The best thing you can do now is to stop trading. When you have that kind of disaster, you need to stop trading. You need to think, what am I trying to achieve? What's my method? It's not acceptable for you to be in a situation where you're losing that amount of your investment. That's not an investment. It's gone wrong, you see. So stop trading, think, and reassess your goals. Have a look at that impact of leverage on risk management, and I hope that helps. Okay. Some people struggle with risk management, but once you get this, it will help you. And then it's a long road to recover with your investment, Georgia. As you imagine, like you're looking for sort of double-digit percentage returns is what I aim for. So that's a long road, but use that road to help your education. I'm sorry I can't help more than that, but that is the first task to take, Georgia. Yes, Nikita, long on Euro Aussie dollar. Right, absolutely. Let's look at that. I'll just call that up. Okay, Nikita, let's look at that. Right. So you're long Euro Aussie dollar. Now, what you're doing is the outlook for the euro is weak bearish, and the outlook for the Australian dollar is more neutral. Longer term, there should be an upside bias for the Aussie. It's struggling at the moment because of the slowdown in China, iron ore prices falling, rising COVID-19 cases. So medium term, the outlook is more as the chart shows you, sort of slightly tilted to the downside. There's some medium term upside because of the outlook with the ECB mildly bearish, but Australian dollar is even more bearish in the near term. So you are now in a key overhead resistance area. You see this area here that you're in? That is an area where you should expect profit taking. So basically, if I was long Euro Australian dollar, I would take my profit here. Now, the only way this would work is if there's more positive development for the euro. So if the ECB become more bullish, if the outlook for the European economy strengthens, then you'd expect more euro upside, and you'd expect the euro to attempt to break out. For now, this key resistance area is the obvious target for buyers. So being long Euro Australian dollar, given the fact that the outlook is weak bearish for the euro, neutral for the Australian dollar, remember that image that I shared with you, Nikita, at the start. We want strength against weakness. You've got mild weakness against a bit more arguable mild weakness, mild strength. Okay, so you've got like two arms that are more similar to each other. So given the fact that it's the Australian, this has been driven by the Aussie dollar weakness, right? That's the big driver here. So if the Aussie dollar weakness continues, then this could break out higher. In which case, what I would take profit here. If it breaks higher, then you can always re-enter on a retest. I'm not sure it will break higher. Obviously, I can't tell the future. It will depend on the risk events and what happens. But I hope that helps, Nikita. Hope that helps. A great trade, by the way. Yeah, and the Georgia. Yeah, what I was saying to Georgia is, it's very hard when you lose a large amount of your account. It's a devastating blow, right? But it's not a blow you can't recover from, the George A, okay? You can recover from it and just use it as an expensive lesson. Many traders have done exactly the same that you've done. And sometimes it's only in making that mistake that you learn never to do it again. So hopefully you can rebuild, and you can rebuild better, okay? Oh, good, Nikita. I'm glad that makes sense. So what you're really looking for is, you can see, like, even with the chart, like if you look at the Aussie CAD, right? Do you see how this is moving much more sharply in this direction because it's clearer? Like the CAD outlook is quite strong. The Australian dollar outlook is, near-term weakness. So we're looking to pair weakness against strength. Once you've got that concept, Nikita, in play, it really helps. So that's what I was saying with the Euro New Zealand dollar pair. So let me show you, and this will make sense to you. Right. Now, this is going into the RBNZ meeting, there was clearly a sell bias for the Euro New Zealand dollar. Why? And think about this. RBNZ was very bullish. Unemployment was great, 4% versus 4.5% expected. Inflation was hot, 3.3% year on year, above the 1 to 3% RBNZ target. Great. Property prices, red hot in New Zealand. All the 4 largest investment banks in New Zealand were thinking that the RBNZ would have to hike interest rates 3 times before the end of the year, right? Then, the day before the meeting, we had 1 COVID-19 case in New Zealand. The New Zealand dollar weakened, Euro New Zealand dollar shot higher. That wasn't Euro strength, it was New Zealand dollar weakness, right? Now, the RBNZ met. They were expected to hike rates. They didn't. They held. But Governor Orr said, okay, yeah, employment is great. Inflation is hot. We'll keep a careful eye on it. Property is unsustainable. And their projections were they're going to hike at the end of this year and 4 times next year. So what they've said, Nikita, is they're staying on track for hiking. Now, there was 3 more cases this morning of the Delta variant. So we saw the New Zealand dollar weaken again out of the meeting. When the meeting happened, originally the New Zealand dollar weakened because instead of hiking rates, it was a hold. But then it retraced because the bank's still optimistic, which is making sense. So then we see, well, okay, short term, there's reasons for New Zealand dollar weakness, but medium term, we're expecting the RBNZ to hike rates this year and 4 times next year, whereas the ECB, we're expecting them to be far more dovish. So as a consequence, we have that Euro New Zealand dollar downside bias. So that's why it's suitable for selling at market with stocks above 1.7150. Do you see? And that's how we put it together. And it's all revolving around this fundamental philosophy of pairing strength against weakness. And once you have that, once you've unlocked that way of thinking about the markets and you're studying central bank monetary policy and the projections of central banks, then you can see through the ebbs and flows of the market. Right. Now, does that mean that the Euro New Zealand dollar is definitely going to fall lower? No. Does it mean that level's definitely going to hold? No. But what it does mean, at the moment, the RBNZ are projected to raise interest rates, and we'd expect the New Zealand dollar to find medium-term strength. Do you see? So it's a balance of probabilities, and then it's where do you manage your risk? I hope that makes sense. Folks, been a pleasure. Look out for the FOMC meeting minutes and look out for that dollar yen upside bias and pound Australian dollar bias, and also that Aussie CAD outlook, just look at that, look how it trades. You'd expect to see a retest of that 0.912728 region today with a break lower there. Any retracements up to that 0.9174 can be considered suitable for going short today, but this is an intraday trade and not one necessary to hold. Yeah, that's great, Nikita. Super. Thanks, everyone. Take care now. Goodbye.